This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Win streak. The Dow and the S&P hit records, rising for 6 straight weeks. And with rates expected to stay lower for longer, our higher yielding stocks, the dividend payers, set to outperform.
Cutting the quota. The government proposes cutting back on the amount of ethanol in gasoline, handing a victory to oil companies and potentially consumers. But the move comes at a cost.
And Market Monitor, our guest tonight, has 2 energy plays that he says are must-own stocks. All that and more tonight on Nightly Business Report for this Friday, November the 15th. And we say good evening, everybody. I'm Bill Griffith. Tyler Matheson is off tonight.
And I'm Susie Guerin. Good evening from me as well. Big round numbers and new records on Wall Street today. The Dow is near the 16,000 level for the first time ever. The S&P 500 index just points away from 1,800, a new milestone. And NASDAQ 4,000 just around the corner, a level not seen since 2000. Those are new records for the Dow and the S&P, and both averages have posted gains for 6 weeks in a row. Also closing at new highs, the Dow Transports and the S&P Midcap 400 stock index. So here's a rundown of the closing numbers today. The Dow jumped 85 points. The NASDAQ added 13. That's a new, fresh 13-year high. And the S&P rose 7.5 points. Seema Modi has more on the recent bull run-up, which stock sectors are making the biggest gains, and why high dividends really matter to investors.
Stocks have been on fire this year. One of the big reasons, the Fed's monetary policy. And with Fed nominee Janet Yellen's dovish commentary yesterday,
we expect to maintain a highly accommodative monetary policy for some time to come.
Expectations are that rates will stay lower for longer, and experts say that's a boon for stocks.
The strength in equities owes much to very low interest rates. Fed funds may be close to 0% until the middle of 2015. Bond yields moving higher. I don't think that the equity market will come under much pressure from significantly higher interest rates anytime soon.
Historically speaking, in a low-rate environment, high dividend-yielding stocks do outperform as investors are on the hunt for yield. Healthcare and consumer staples, 2 sectors that offer the highest yield, are up over 80% since the Fed cut rates near zero in 2008. And while consumer staples and healthcare stocks are already up double digits this year, analysts say some of the stocks in these sectors are trading at an attractive valuation. Within pharma, Pfizer trading at a discount to its peers, and in the consumer staples sector, Altria and Walmart. But some say these defensive sectors are overvalued, and technology is the place to be. In fact, many of the large-cap tech giants offer an attractive dividend yield. Apple and Qualcomm both offer a dividend yield above 2%. Although Dan Greenhouse at BTIG says with the yield on the 10-year Treasury note rising, investors are becoming more selective and looking for names that offer a yield higher than the yield on the 10-year note. According to Wisdom Tree, fewer than a third of stocks on the S&P 500 have a dividend yield above 2.7%, which is the yield on the 10-year Treasury. Big names in that group, AT&T, Entergy, and PG&E. But whether it's defensive sectors like healthcare and consumer staples or high-growth sectors like tech, one theory experts agree on, dividend stocks will be high in demand as long as interest rates remain low. For Nightly Business Report, I'm Seema Modi.
And joining us now to talk more about the financial markets and what it means for your portfolio is Daryl Kronk. He's Regional Chief Investment Officer at Wells Fargo Private Bank. Daryl, thanks for joining us tonight.
Thank you, Bill. Great to be here.
Are there any headwinds that could stop this? I mean, we've had 6 straight up weeks now. We've been through the tough months of September and October with great gains. Where is the weakness in this market?
Yeah, I'm not sure you're going to see a lot of it. I mean, we only have 30 trading days left in calendar year 2013, so I think we'll start to look forward into 2014, Bill. And as we look into 2014, I think the environment sets up really nicely for overall economic growth, and some decent earnings growth in 2014. So I'm not sure there are a lot of headwinds. Valuations are reasonable, both on an absolute basis and certainly on a relative basis to your earlier point and the earlier segment about where interest rates are. And also don't forget cheap inflation at today's, or low inflation at today's levels.
Daryl, I'd like to follow up on the report that we just had from SEMA, where she is talking about, you know, the Fed-friendly market. But at some point, the Fed is going to cut back on the stimulus. What are the companies that you think will be the growth winners in that environment? And do you agree with some of the stocks that SEMA was talking about?
Yeah, actually, I think as you turn the page into 2014, what we're really focused on is you've got to think in terms of what I'd call growth winners versus liquidity winners. And so what I mean by that is sectors of the economy that are going to stand on their own 2 feet on growth and not necessarily just be dependent on the excess liquidity in the market. So I would give you, Susie, a couple of sectors. We like the tech sector. Certainly valuations there. The tech sector is trading at a discount to the market multiple today, and it normally trades at about a 20% premium. So extremely cheap. And actually, technology companies as a sector have more cash on their balance sheet today than they do debt. They have low payout ratios, so really favorable. We also like the industrial sector. That tends to be a sector that benefits mid-cycle to late cycle, and you're seeing the U.S. manufacturing renaissance really play through to that. So those are growth-winning sectors. You know, liquidity-winning sectors are going to be things like utilities and telecom, maybe to a lesser extent healthcare. That we think valuations are getting a little stretched there right now, to be honest.
What about those? Well, you mentioned utilities, but dividend players, I mean, those that have been helping people achieve a yield you can't get in the bond market, and they have been a darling of this market for a couple of years now. Is that too crowded a trade, or would you look to them as well right now?
No, we've actually got most of those, Bill, underweight right now. So, if you look at utilities, telecom, probably the two, maybe staples to a lesser extent. We do think staples will still benefit simply from the wealth effect of the consumer and continuing spending. But those pure dividend plays look really expensive to us right now. So while you can't get away from them completely, and it's important to have a diversified dividend in your portfolio, we think they look expensive. The only other point I'd add to that, Bill, is we're looking globally and internationally to dividends right now. If you look at a lot of countries overseas, their actual dividend rates are considerably higher than the U.S., and you get better diversification benefit as well, and in some cases a much more reasonable valuation level. So I think investors have to look global as well as just domestic and staying with domestic S&P sectors.
Daryl Cronk of Wells Fargo Private Bank. Thanks for joining us tonight, Daryl.
Thanks, Bill. Appreciate it.
Some big changes may be coming to your gas tank, but also it could mean higher prices at the grocery store. Bowing to pressure from the oil industry, the Environmental Protection Agency is proposing a sharp reduction in the amount of ethanol, which is mostly made from corn, in the nation's fuel supply. Jackie DeAngelis has more on what that could mean to energy companies, corn farmers, and consumers.
The EPA proposing for the first time today to ease and lessen the requirements for ethanol in gasoline. This is quite significant because the agency for the first time acknowledging the fact that this mandate requirement set in 2007 may be difficult or potentially impossible to meet. The EPA asking refiners to blend 15 billion gallons of renewable fuel into U.S. gas supplies. That's roughly 16% less than what Congress's 2007 renewable fuels law requires. The impact of this on the markets? Well, corn futures were immediately lower on the news. That's because ethanol comes from corn, and this proposal would reduce corn demand. In addition, the refiners spiking on this because it brings their costs down. And finally, if it's cheaper for the refiners, it means it's cheaper at the pump, and thus gasoline futures also seeing a decline. Some other implications to consider here. Ethanol demand is dropping off a bit because of the recent surge in domestic oil and gas supplies. In addition, demand for transportation fuel also dropping. That makes ethanol less appealing. Finally, using corn and ethanol makes the corn price more expensive. This, of course, makes it tough for those ranchers out there who use corn to feed their animals. For Nightly Business Report, I'm Jackie DeAngelis.
Elsewhere, J.P. Morgan Chase, of course, the nation's largest bank, they've agreed to a $4.5 billion settlement with investors over bad mortgage-backed securities the company sold ahead of the financial crisis. The same group of 21 institutional investors already received an $8.5 billion settlement from Bank of America on similar claims.
A clear legislative rebuke to the troubled health care law today. The Republican-controlled House passed a bill aimed at undermining the Affordable Care Act, voting to let insurance companies renew canceled plans and sell individual health plans to anyone, even if they don't meet coverage requirements in the new law. 39 Democrats broke ranks supporting the so-called Keep Your Health Plan Act. The bill now goes to the Democratic-led Senate, where it is expected to fail.
And, of course, all of this comes as President Obama met with top healthcare insurance CEOs today at the White House, trying to drum up support for his latest fix to the troubled law. He urged those companies to reinstate thousands of policies that were canceled, and he enlisted their help to get the problem-plagued healthcare.gov website back on track as well. The president spoke before the meeting about the need to reach out to those executives.
I appreciate all these folks coming in. We're going to be soliciting ideas from them. There's going to be a collaborative process. We want to make sure that we get this done so that in the years to come, every American is going to have the kind of affordable health care that they all deserve.
Well, John Harwood joins us once again from Washington tonight. Of course, we'd all love to know what was said in that meeting after the president spoke. But really, John, what happens next at this point?
Well, the most important thing that happens next is the effort between now and November 30th of the administration to meet its pledge to get that website functioning smoothly. They've reported some progress so far, and it was interesting that in the outset of the meeting, including that bite that you just played, Bill, the president made clear his agenda for the meeting wasn't just about that fix, which may be of dubious impact in the long run. We don't know how many people will be affected by that. But enlisting those executives to help work around where necessary the problems with the website, communicate with customers, get people signed up. Because the thing that's ultimately going to determine the success or failure of this law is whether they can get a critical mass of people to sign up under the exchanges, under the new pricing structure that has left the old one behind, which is why you're not going to see that many policies get extended into 2015. If they can get that working, get people to see the choices that they have, then the law's got a shot to succeed.
John, you mentioned that November 30th deadline. I don't know if that's still going to stick. Maybe you don't know either. But there have been so many deadlines, and they keep changing. Which are realistic that they're going to stick, and which ones won't?
Well, the reason that November 30th is so important is that in order for people to be covered on January 1, and there are a lot of policies that expire at the end of 2013, you've got to be able to sign up by December the 15th and pay a premium. November 30th gives you 2 weeks after that for that to happen. Now, the pattern that we've seen and every company sees when they have open enrollment is it tends to come in a flood at the end. So if it's not right at the end, you're going to have real problems heading into January. Beyond that, you've got a deadline of March 31st. That's the end of the open enrollment period. That's the last point at which people can sign up and be deemed to be covered under the individual mandate.
How much you want to bet those deadlines change again next week, and you'll be telling us all about it. Thanks so much, John. John Harwood reporting from Washington. And still ahead on the program, Sony releases the first update to its PlayStation game console in 7 years, and it could hold the key to the struggling electronic company's future.
Sales of video game players were lower again last year. The NPD group, which tracks the sale of gaming hardware and software, said the sales of consoles last month fell by 8% compared to October of 2012. But the sales of games themselves shot 12% higher this past year, thanks to some must-have titles like Grand Theft Auto 5 and Pokemon X and Y.
Well, sales of game consoles are expected to pick up sharply very soon, and that's because two of the biggest manufacturers of game players are putting out brand new systems just as the holiday shopping season kicks into high gear. And as Josh Lipton tells us, the newest console from Sony, just out today, is off to a terrific start.
From New York,
yeah, we doing this,
to San Francisco, hardcore gamers lined up outside of stores for one of the most anticipated launches in years.
Yeah, we've been waiting for a while for this. This is a big deal. 2, 1.
At midnight on Friday, Sony officially launched the PlayStation 4 in the U.S. It's the first shot in the upcoming video game wars. Microsoft is expected to release its Xbox One next week, which will be Sony's biggest competition in the battle for hardcore gamers. And with analysts pegging the global console market at around $10 billion, it's a battle that neither side wants to lose.
So how do these two consoles stack up? Well, the features are actually pretty similar, but here's the big difference. The PS4 will retail for about $100 less. Sony's hoping that's going to give it the competitive edge it needs to beat out its rival.
In terms of the overall numbers, we're planning on selling around 5 million units worldwide by the end of our financial year, end of March. And that's significantly ahead of where we were with the last generation of PlayStation 3.
Morgan Stanley forecasting similar numbers, with expectations for Sony to sell around 3 million units by the end of the year. And any way you slice it, Sony has held a pretty dominant lead in terms of hardware units shipped to retailers this year. Analysts say Sony has a lot riding on the launch.
I think Sony, if it wants to get back to make its own predictions for where it will be in a couple of years in terms of profitability, the PS4 platform has to succeed.
Sony, once seen as the premier name in consumer electronics, has lost its luster. The stock is down nearly 50% over the past decade, with companies like Samsung and Apple now dominating the space. But this year, shares have bounced back, tacking on about 65% since January. Bulls, like the team at Morgan Stanley, pin their hopes on faster restructuring at the company, especially for its PC and TV segments. And a strong showing from the PS4 could go a long way in helping Sony win back consumers. Josh Lipton for Nightly Business Report, San Francisco.
Elsewhere, 1 week after Twitter's successful initial public stock offering, options on shares of the microblogging site began trading today. But shares of Twitter ended 1.5% lower today after an analyst downgraded it at S&P Capital IQ. They noted that all the money the company's been spending lately to expand their business.
Joseph A. Bank is pulling its bid to buy Men's Warehouse, and that's where we begin tonight's market focus. Now, Joseph A. Bank's $2.3 billion unsolicited proposal to acquire its larger rival Men's Warehouse expired yesterday. Now, although Men's Warehouse never entertained that bid, Joseph A. Bank said it would still be open to future talks. Shares of the retailers were up on the news. Men's Warehouse rose 1% to $46.63. Joseph A. Bank up a fraction to $50.72. General Electric plans to spin off its credit card business next year as a separate public company. The move would take GE out of retail lending in North America in an effort to make less money from the volatile financial sector and more from manufacturing. The stock rose a fraction today to $27.20.
Agilent Technologies climbed to multi-year highs after reporting strong fourth-quarter earnings. The scientific instrument maker beat on both the top and bottom lines, but guidance missed Wall Street's estimates. Weak guidance did not weigh on shares, though. The stock surged by more than 8.5%, closed at $54.93. And investors bought up shares of Zulily in the company's Wall Street debut. That discount retail site that targets moms priced shares above an increased range around $22, and shares took off, ending the day up more than 71%, closed at $37.70.
Our Market Monitor guest tonight is bullish on stocks, but says investors should prepare for stocks to pull back in these last trading days of the year. He's Peter Sorrentino, Senior Portfolio Manager at Huntington Asset Advisors. So, Peter, it sounds like a little bit of good news, bad news. Tell us how much of a pullback you're expecting over these next couple of weeks, and then how do things look for 2014?
Well, thank you, Susie. We really look for a rotation in leadership. As you pointed out earlier segment, the value dividend paying segment has had a great run the past couple of years. And with softening in commodity prices, we think we're going to see a rotation in leadership. And that will lead to, we think in combination with the tax selling that usually occurs at this time of year, some weakness in the leadership as we get the new leaders emerging. And again, in one of your earlier segments, you talked about technology, and we think those are the segments that are going to see cash flow and the ones we want to be in into next year. But in that transition, we think it's less than 5%, but we do see some potential weakness as portfolios get repositioned and investors take advantage of whatever tax opportunities they have in their portfolios.
The biggest pullback we've seen all year, we've had a few 5% pullbacks, but it's been forever, it seems, when we last had a typical 10% correction in this market. You still don't see that in the offing either, do you?
We don't. Really, with the softening of commodity prices, especially on the back of the news today from the ethanol rebate, if you will, back to the markets, that we don't see commodity prices threatening anytime soon. Interest rates are effectively a reflection of inflation pressure. With that taken off the table and a pretty clear understanding of what's going to happen with Fed policy, we don't see much of a threat to the market in here. And the data we've been getting coming out of the private sector in terms of the economy looks pretty good and looks to be picking up some momentum. So we think the economy holds together.
All right, Peter, let's go down some of the stocks that you are recommend. You were talking about tech a moment ago, and you have EMC on the top of your list. Pretty much the stock is trading at the same level it was at the beginning of the year. Why do you like this, and where do you see it going?
Again, this is a growth name, and it's one that investors really have been passing by. It doesn't offer a big dividend, no big buybacks, no special activity. But looking at their suite of products, especially in the area of data storage, disaster recovery, this is the kind of name that as business expands, this is a necessary going forward. And there's a lot of regulation going out now with regard to businesses and their ability to come back from a disaster. And when we see the security issues, data today coming out that the Options Exchange Board had a problem. So we think security and disaster recovery become big themes, and EMC is really well positioned to take advantage of that.
You like natural gas, the fact that you're thinking we're going to see much higher prices down the road, and a company you feel that will benefit is Schlumberger. Why?
Well, because prices collapsed so much in the last couple of years, we really saw North American drilling activity fall off dramatically. We view that that's going to come back very strongly. They've had good success outside the U.S., outside North America, and we think that they'll continue. And we like Schlumberger, very high quality, strong balance sheet, and their array of products really speak well to the type of activity that we think you're going to see in the North American drilling environment in the year or a couple years ahead, really.
All right, let's talk a little bit about another stock sort of in the energy area. Chicago Bridge and Iron, CBI is the ticker there. Stock almost has doubled. It's about $80 now. What's your target on this, and what's the attraction?
Well, this is a name that is an industrial, and a lot of people think of this as one of those that you would probably want to avoid after the run it's had. But the natural gas story, as it comes back here in North America, and we move from essentially being domestic consumption to an exporter of natural gas, Chicago Bridge and Iron has a huge technology footprint in both the liquefaction and gasification of natural gas. They benefit not only from the projects being built here in the North American market, but also those around the globe. So as natural gas continues to expand in terms of a replacement fuel for electricity generation, we think Chicago Bridge and Iron is really just in the right place to benefit from it.
Okay, terrific. Any disclosures, Peter?
Do not own any of the names personally. We do own them in the funds, and we own less than 5%.
Okay, great. Thank you so much. Have a great weekend. Thanks for coming on the program. Peter Sorrentino, Senior Portfolio Manager at Huntington Asset Advisors.
And coming up, will falling gasoline prices and a rising stock market put consumers in a spending mood this holiday season? So do you plan to do any shopping on Thanksgiving? How about Black Friday the day after, or the rest of that holiday weekend? A new survey out today from the National Retail Federation showed that up to 140 million Americans plan to hit the stores over that long Thanksgiving weekend. That's actually down a bit from last year, but more shoppers than ever are planning to head out on Thanksgiving Day itself this year.
You better get going. Christmas is just now 39 days away, and many consumers are already figuring out where they're going to shop and how much they're willing to spend. So, will the current economic environment be naughty to shoppers and retailers this year, resulting in disappointing spending, or will it be nice, giving the whole economy a lift? Courtney Reagan takes a look.
Each holiday season comes with its own set of broader economic issues that often impact consumers' budgets for gift giving, and this season is no different. Higher payroll taxes, lack of confidence in Washington lawmakers, and higher health care costs are cutting into consumers' budgets, adding the hit to confidence from continued uneasiness about the job market and sluggish economic growth, and the naughty list looks fit for a Grinch. But then again, competition for consumer dollars is so intense that retailers are offering some of the best promotions in years, and online shopping options have grown in number and ease. Plus, home values are rising. The stock market continues to hit fresh highs. Weather trends are favorable, and holiday shopping season gas prices are the lowest levels in 4 years. That all makes the nice list quite jolly.
Historically, when gas prices fall this time of year, consumers shift those savings to their holiday gift buying. But it doesn't seem to be the case this time around.
According to a new Gallup survey, the more than 1,000 consumers surveyed reduced their forecast for spending on Christmas gifts to an average $704, $82 below their October prediction and $66 below holiday shopping intentions this time last year.
The economic headwinds are still tough, and we expect it's going to be a very promotional but a very solid holiday season.
While retailers have issued mixed forecasts about the holiday season, many at least say sales and traffic have been improving. Walmart U.S. CEO Bill Simon told reporters the various headwinds and tailwinds in the marketplace, many of which we haven't seen in combination before, make consumer shopping intentions hard to forecast. But there's always a chance for a Christmas miracle. For Nightly Business Report, I'm Courtney Reagan.
So you're going to do online shopping?
Mostly online shopping, and I'm not one that goes out on Thanksgiving either.
Not me.
Yeah, you'll be too tired. You're making dinner this year.
I have 16 people, lots of pumpkin pie. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for watching. Great being with you, Bill.
Always enjoyed being here. I'm Bill Griffith. Have a great weekend, everybody. See you Monday.
Nightly Business Report has been brought to you by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. New records for the Dow and the S&P today, with both averages posting gains for 6 weeks in a row. The Dow jumped 85 points, nearing the 16,000 mark. The Nasdaq added 13, and the S&P rose 7.5 points, just points away from the key 1,800 level. President Obama met with top health insurance CEOs, urging them to reinstate thousands of policies that were canceled and asking them to help get the troubled healthcare.gov website back on track. J.P. Morgan has agreed to pay a $4.5 billion settlement to a group of investors over bad mortgage-backed securities it sold. And the White House proposed cutting back the amount of corn-based ethanol in gasoline, potentially making prices cheaper at the pump. Be sure to tune into Nightly Business Report right here on your public television station.